So hi everyone. Hi everyone. Welcome to today's workshop. As Michelle mentioned, my name is Emily Ranta. I use she, her pronouns, and I'm a fourth year social work student on the Aurelia campus. The Canadian Foundation for Economic Education is pleased to partner with the National Bank of Canada to provide a series of workshops to help post-secondary students across the country get a better handle on their money. Today, we're going to be looking at alternative investments, an entirely different field of investing with its own unique properties. The workshop will last about an hour, and then as Michelle mentioned, we will have a live Q&A at the end of the presentation. These workshops are intended to serve as a foundational research to get you thinking about your finances, not as a final stop in your financial journey. Consider the information and see how you can apply the concepts covered to your personal financial situation. Also, please understand that while we will do our best to answer all related questions, we will not be discussing any questions on topics beyond the scope of today's session. If you have any specific questions that we're unable to address, please consider setting up an appointment with a financial professional. As Michelle mentioned, we sent a pre-survey we hope you completed. And again, there will be a post-survey sent at the end of the session. If you fill out both, you'll be entered into a draw for one of four $50 Tim Hortons gift cards chosen among eligible students this semester. And don't worry, they will not be using your email address for any other reason except for this draw. All right, so let's get into it. So the program that we're talking about today is Help Managing Your Money on Campus. Is designed to help students by providing comprehensive financial education modules. This is so important and timely because more than ever, we live in a complex financial world. The majority of you have likely already experienced this world of financial costs, responsibilities, planning, spending, debt, credit cards, and much more. And that's exactly why they've partnered with universities and colleges across the country to help equip students with the information you need to take on all of life's financial challenges. They asked students what their priorities are in the first half of 2020 and what they wanted to learn more about. 1,500 surveys later from students all across the country, this is what they found out. Hopefully, most of you have attended the workshops on the basics where we introduced like why to invest, the magic of compound interest and growth, the types of investments and accounts, and how to get advice. This module will go deeper on investment strategies. So the survey findings, 76% of students listed investing money for the future when asked specifically what topics they wanted more information on. 64% of respondents wanted to learn how to deal with financial stress, and 55% of respondents wanted to build a financially healthy lifestyle. They hear your questions and they understand your challenges, and that's why they put together today's session. So to start off, it's worth mentioning that in the world of investing, there's a lot of jargon, but that's really common for any subject. So for example, in the medical field, they have cryptic jargon such as acute and negative. And of course, in the business world, they have lingo like bang for your buck and due diligence. I mention these terms because perhaps you're more familiar with them than you are with investing language. But either way, it speaks to the fact that every subject area has terminology. So today we are going to go over several intermediate and advanced terms to help you speak the language of investing. So just out of curiosity, is anyone familiar with any of the terms on the screen? No, that's all right. We're going to talk about some of them today. So what we're actually going to be talking about today are alternative investments in general, why they're appealing, why they can be risky, and how they fit into a diversified portfolio. Then we'll look at some of the main alternative asset classes, how they work, and how and why they could be added to a balanced portfolio. Finally, we'll dig deeper into a popular growing alternative asset field, cryptocurrency, and the virtual market that is emerging around these digital coins. So coming out of this workshop, you should know how alternative investment classes differ from the regular market, understanding the risk and return profile offered by some of these different alternative investments, and be able to recognize differences among how different types of cryptocurrency act and why you might invest in one over the other. So first, let's talk about some alternative investments. So to start the workshop, we're going to be looking at alternative investments in general. So what do alternative investments actually bring to the table? What are the risks that come with participating in non-standard investments? And can alternative investments be part of a well-balanced portfolio? So the first step in truly understanding why alternative investments may be appealing to some investors is to look at what's covered by the term alternative investments. This can be extremely broad, but generally it refers to investment vehicles that are not the main classes of funds, which we've already talked about, like cash and equivalents, fixed income, equities, mutual funds, and ETFs. Examples of alternative investments are things like real estate, hedge funds, private capital, commodities, derivatives, and cryptocurrencies. In section 2 and 3 of the workshop, we are going to go further into specific examples of alternative investments, but there are a few things they all tend to have in common. They have a unique risk and return profiles that can be difficult or impossible to replicate in the standard market, and they behave in unique ways, sometimes responding opposite to the market and sometimes completely disconnected from what the standard market is doing. So a common appeal to some of the alternative investments is the ability to act as a hedge against inflation. So what does this mean? To be a hedge against inflation, an item must gain value over time at a rate proportional to standard inflation rates. So for example, a perfect inflation hedge would gain the exact same percentage of value in a year as the current inflation rate. If the inflation rate is 5%, that means it will cost 5% more to purchase standard items in a year's time. And a perfect hedge against inflation would sell for 5% more than when you bought it a year earlier. This rise in value of 5% allows it to counteract the loss of purchasing power caused by inflation, similar to how putting your money in a savings account offering 5% interest would. Commodities are known for serving as a potential hedge against inflation, as they are the raw materials that are in demand for their intrinsic value, things like grain and precious metals. Like with the main asset classes, different alternative investments come with drastically different risk and return profiles and behaviors. We would never be able to look at all of the alternatives and dissect the risk and behavior profiles of each in an hour presentation. So if there are options that interest you, be sure to do your own research to understand how those investments act. In the world of alternatives, we have lower risk options that focus on maintaining their value over time, all the way to the more speculative investments and even cryptocurrencies, which can grow by thousands of percents in a month or fall just as quickly. While these unusual risks and behavior can seem alarming at first, having investments that aren't connected with the standard market can potentially help you maintain value if the market dips. They can also offer different sources of income. Choosing a more stable alternative investment like precious metals or purchasing a primary residence can add some stability you would normally turn to fixed income investments for, while providing you with the more tax-efficient capital gains as your source of income rather than interest. Higher risk alternative investments can also be a great addition to a well-diversified portfolio by offering the potential for returns while using your combined investment to mitigate loss. So not everyone is interested in going to lengths to build complex investing profiles. For many, standard investments are sufficient because they aren't prepared for the additional risk and non-standard responses of alternative investments. This means there are generally far less people involved in alternative markets and investment opportunities, making them less liquid. With less people interested, it can be hard to sell the asset when you are ready. And for some, once you've committed to it, it can be almost impossible to get back out without taking any loss on your investment. Even many that are already in demand, like commodities, can have their price influenced by hoarders dumping large quantities into the market, which could have a drastic impact on your returns if you are forced to sell because you need the money. Because of this liquidity risk, it is really important that you understand your horizon before investing in alternatives. With some alternatives, there is also a risk that your initial investment may end up feeling like it's just the tip of the iceberg. Investing in private capital could require additional future investments to help support the company to an initial public offering or profitable position where you can sell your investment. Investing in some derivative like options can offer an initial return while creating a significant obligation if the conditions are met. In some extreme situations, strategies to minimize loss can instead backfire and lead to virtually unlimited loss. Be sure to understand all terms and conditions before investing. While there are alternative investments that are regulated, like traded derivative, publicly traded commodity stocks, and hedge funds, many are not. And of those who are, the regulations are often different from other more typical asset classes. Less regulation means less security for you and your investment. There are fewer expectations from companies, the potential for less transparent reporting, and in the case of assets like cryptocurrency, which were created for the purpose of not being regulated, there can be little to no repercussions if something goes wrong. Quadriga CX is a cryptocurrency exchange that has revealed to be an entirely fraudulent when the founder, Gerald Cotton, passed away. Because there were no regulations protecting the crypto industry, he was able to collect money from people under the pretense of selling them crypto. But he was using the money instead for personal gain. When the company collapsed, Quadriga customers were owed a combined $215 million, of which only $46 million were recovered. Recall that diversification, is a key portfolio tenet. It means to not put all of your eggs in one basket, and helps to try and ensure that if one part of your portfolio is down, another part of your portfolio may be up in price. There are many factors you can consider to add diversification to your portfolio. In our Building an Investment Portfolio workshop, we looked at how to diversify by choosing different asset classes, locations, and the risk levels for investments. The inclusion of alternative investments in your portfolio can offer additional variety in terms of the investment type and level of risk, but also introduces a new diversification element, market behavior. As we've looked at, the fact that alternative investments can work independent of the rest of the market can serve as a potential tool to help establish balance within your portfolio. When the market is down, certain alternative asset classes may be performing well. Keep in mind, though, that the opposite can also be true. A strong stock market may lead to poor results from certain alternative options. While some alternative investment categories can be very risky, that is not always a bad thing when taken as a part of a well-balanced and diversified portfolio. The image here is a breakdown of the different asset categories the Canada Pension Plan Investment Fund holds at the end of March 2021. As you can see, their diversified portfolio contains holdings from many different asset categories, from public equities to private equities to bonds and real estate, in order to mitigate risk and build stability. So some key takeaways from this section are that there are potential pros to including alternative investments in your portfolio, like working as a hedge against inflation and providing different risk, return, and behavior profiles. The unique way that alternative investments can act and the decreased regulations can also make them very risky. And finally, diversifying your portfolio can help reduce the risk associated with some alternative investments. In this section, we're going to dig into some alternative asset classes available. So before we move into this section, let's have a quick poll to test your knowledge. Are alternative investments, all alternative investments have the same level of risk, true or false? Perfect. So the answer is false. So good job, all three of you who answered. Alrighty. So alternative investments are a very diverse field, and as we will see in this section, they can come with a variety of different risk levels. So in this section, we'll be looking at some different alternative investments available. While some may generally be considered lower risk investments, it's important to remember that even a low risk investment does have some risk. Do your research before putting your money into anything to ensure that you understand what you're actually getting into. So market-linked GCIs are a guaranteed investment certificates, which interest rates that vary based on the with interest rates that vary based on the stock market. In general, GICs are very low risk investments as they come with a set price, with a set term, and usually a fixed interest rate. Because of the security, the interest rate on standard GICs tend to be very low, ranging from 1 to 4% annually on average. A market-linked GIC also offers a set price and term, but the interest rate is available and linked to the performance of a specific index in the stock market. If the value of the market goes up, your interest earned goes up. If the value goes down, your interest earned goes down as well. These GICs are typically principally protected, and so if the market is down over the term of the GIC, your return is likely floored at 0%. Like GICs, market-linked GICs are available at most banks, including major banks in Canada. The conditions of the GIC are very important to understand your potential gains and how your variable rate will work. Generally, you will only get a percentage of the gains made by the market during the term. So for example, you might only get 40% of the price appreciation of the underlying index, and you will not receive any of the dividends. And the interest may be capped at a certain point. For example, the cap might be, say, around 10% annual interest, even if the underlying index return is much higher. If the market does not perform well during the term of your GIC, you could end up earning less than the rate of a fixed GIC and may potentially earn no interest during the entire period. If the market does perform poorly during your term and you earn no interest, your principal will still be refunded in full at the end of the term, which is why these GICs tend to be lower risk and lower return option. There are no explicit fees in market-linked GICs, but do be aware that there are several embedded fees for the bank. Commodities. So commodities are raw materials, so things like food, water, oil, and metals, along with many others. Within the commodities umbrella, there are varying risk profiles for the different materials. So for example, things reliant on weather for production can be impacted by a natural disaster, or those with limited quantity may be susceptible to hoarders affecting price. There are many different ways to get involved with commodities, from purchasing the items directly, like buying precious metals or non-perishable foods, to investing in ETFs that follow the commodities market. For example, of ETFs that follow commodities would be iShare Global Agriculture Index, or COW on the TSX, which offers exposure to companies involved in the agricultural industry, iShares Global Water Index, or CWW on the TSX, and in iShares Capped Energy Index, XES on the TSX, which focuses on companies in the Canadian energy sector, and iShares Global Base Metal Index, or XBM on the TSX, which follows companies involved with base minerals like copper or zinc. The stock market offers shares of publicly traded companies, but in the United States, publicly traded companies make up less than 1% of all US firms and only about 1/3 of employment. This means that limiting your investments to only publicly traded companies removes 99% of all businesses in the largest market in the world. There are some significant difference between public and private companies, both in the way you invest and the information available to make decisions. Investing in public companies is relatively easy. You identify their stock ticker and purchase shares through a broker. Investing in private companies can be more complicated. You can look at offering private loans to companies or purchasing shares through a private offering. However, the easiest way for the average investor to add private equity to their portfolio is through ETFs that follow private equity funds. These funds pool investor money like mutual funds, but often require significant financial investments to participate. Private equity ETFs like Invesco Global Listed Private Equity Portfolio or VanEck BDC Income ETF can offer exposure to 70 plus private holdings for about $10 per share. The other big difference between public and private companies is the required reporting standards. There are two main accounting standards in Canada, and private companies are allowed to produce their financial report using either one. This means that it can be more difficult to compare companies since they may be using different yet still fully legal reporting systems. These different standards require less transparency, which can increase the overall level of risk for investors. An example of this is Bridging Finance, a privately held Canadian company that offers alternative financing to other Canadian companies. In 2021, the Ontario Securities Commission stepped in amid concerns that the firm was dealing with a number of undisclosed conflicts of interest. After a year-long process of investigation and liquidation, it is estimated that of the $2.1 billion in investor money the firm was managing, more than half of it can no longer be accounted for. While these types of problems are not exclusive to the private market, the additional transparency of the public market goes a long way toward removing them. So hedge funds. Hedge funds are pools of investor money, similar to mutual funds or ETFs, that are allowed to operate with far less extensive regulations than either of the two funds, allowing them to use non-traditional, risky investment strategies in an attempt to maximize investor returns. The hedge funds look to ride the line between risk and return by utilizing concepts like financial leverage, taking on additional debt, and other alternative investments like derivatives to bring home large potential returns for investors. Because of the inclusion on non-share assets and alternative investments like derivatives, hedge funds can perform differently from the market, potentially performing well even when the market is declining. The opposite can also be true. Some hedge funds have collapsed from poor decisions made by the manager while the market continued on. Because of the financial leverage taken on by the funds, the potential for return is greater, but so is the potential for loss. Hedge funds are allowed to operate with less regulations than other funds, but in order to protect investors, the barrier to entry is also much higher. In order to invest, you must have a net worth of over $1 million and earnings of $250,000 per year or more. This is because hedge funds can be extremely risky and lose a lot of money really quickly if something goes wrong. So how can new investors get involved? Liquid alternatives, can also be called alternative mutual funds, are a new type of fund available in Canada that is a step between a mutual fund and a hedge fund. They have less regulations, allowing them to utilize some of the same risky investments of hedge funds, but they are more accessible and more liquid, making them easier to get in and out of. The main difference between hedge funds and liquid alternatives is the inclusion of additional regulations, which make the fund safer for the average investors who can't afford to lose all of their money. These regulations prevent the fund from short selling for more than 50% of their net asset value or acquiring total leverage of more than 300% of the net asset value. Liquid alternatives tend to charge rates similar to other mutual funds, but because of the additional risk they take on, they often also charge a premium, which is usually around 15 to 20% of the profits earned. Some examples of the liquid alternatives available in Canada are the Accelerate Arbitrage Fund, ARB, and the CI Galaxy Ethereum, ATHX. While liquid alternatives may be safer investments than hedge funds, they can still be very risky, so it's important to do your research before investing. Derivatives are a financial contract based upon an underlying asset. There are a few different types of derivatives, including forwards, futures, and swaps. What we're going to look at today are called options. Options are an agreement between two parties around shares of a company, giving the buyer the option to purchase or sell the share at a predetermined price by the time the contract expires. Options can also be used to hedge your investments, so decreasing your potential loss or increasing your potential gain, or as a form of speculation. You can participate in an options contract whether you own shares of a company or not, but your role within the contract and the level of risk you will take on change. All right, so we're going to watch a quick little video.
What is a call option? Presented by WallStreetSurvivor.com. A call option is a contract that gives a buyer the right to buy 100 shares of an underlying asset at a certain price by a certain expiration date. Here's Tim. Tim wants to buy a house, but doesn't have the cash to do so right now. He makes a deal with Lori to buy her house for $100,000.
We cannot watch the video.
For the right to enter into this contract.
Sorry?
We cannot watch the video.
Oh, can you see it now?
Yes, please play it.
Okay.
Option presented by WallStreetSurvivor.com. A call option is a contract that gives a buyer the right to buy 100 shares of an underlying asset at a certain price by a certain expiration date. Here's Tim. Tim wants to buy a house, but doesn't have the cash to do so right now. He makes a deal with Lori to buy her house for $100,000. This becomes their contract. For the right to enter into this contract, Tim must pay a premium of $5,000. They agree that this contract will expire in 6 months, so Tim has until then to buy the house at this price. Fast forward 3 months. The neighborhood where Tim purchased the option on his house is booming. The value of the house skyrockets to $130,000. Because Tim entered into the contract, he only has to pay $100,000 for it. Awesome. If he were to resell the house, Tim would have made an immediate profit of $25,000. An underlying asset could be anything from a house to a car or a television, but on the stock market, it is most often a stock. Let's look at how this applies to the stock market. Tim thinks that Google is a great company that is doing some awesome things and that its stock price will likely rise. Tim decides to purchase a call option to buy Google at $600, with the option expiring at the end of the month. On the stock market, one contract equals 100 shares. So essentially, Tim has bought the option to buy 100 shares of Google at $600 by the end of the month. Much like the money Tim had to pay for the right to buy the house from Lori, the price to buy this option is $5 per contract. Since each contract represents 100 shares, the total cost of the contract is $500. After 3 weeks, Google's stock price has soared to $700, and Tim decides to exercise his option to buy the stock. Tim buys 100 shares of Google for $600 for a total of $60,000. Remember, he also paid $500 for the contract, so the total cost is $60,500. If he were to now resell those shares at the current market price of $700, Tim would make $70,000. Because he paid $60,500 for them, he has a net profit of $9,500. Options may seem lucrative, but because they are extremely volatile, they're also extremely risky. Here are a few reasons why you would buy an option. If you didn't want or couldn't pay the full price, if you were protecting your investment through hedging, or if you were speculating and trying to make a lot of money, you can practice buying call options risk-free on wallstreetsurvivor.com.
Perfect. So the video talked about call options, which are based around the asset price rising. In general, you might purchase a call option if you do not own shares of a company, but believe the value will rise. You are purchasing the right to buy them, but not the obligation. Options are the opposite. They are based on the asset price dropping. You might purchase a put option if you currently own shares of a company and are worried the price will go down. You pay a per share fee to guarantee the right to sell your shares to someone else for an agreed upon price. If the stock goes down in value, you can exercise your option and sell it at the agreed price, no matter what it is currently trading for. There are two main risks from option trading. If you purchase an option, you're paying a fee, which you will not get back. If you don't exercise this option, the premium you paid to buy the option contract is gone. Second, if you agree to the contract, you need to ensure you maintain the proper conditions to meet a possible future obligation. If you are the seller of an option, then you need to be prepared to meet your obligations if the purchaser exercises their rights. Publicly traded options can be purchased through a broker and can be held within a registered account like a TFSA. However, excessive options used in a TFSA could be viewed as business-like activity, making it susceptible to taxes. If this is something you plan to do, consider speaking with a financial or tax professional to understand the implications. So the key takeaways from this section are that alternative investments have different risk levels, giving them different places within a balanced portfolio. There are many ways to participate in alternatives, whether it's buying shares or assets directly or through funds like ETFs. And research before you invest in alternative investments so that you understand all of the potential risks. So our final section for today is let's talk about this emerging alternative investment option, cryptocurrency. So we'll start talking about the blockchain technology that makes crypto possible. Then we'll take a look at different types of crypto, and finally some of the risk specific to cryptocurrencies. So when we talk about cryptocurrency, there is another term that always floats around it, blockchain. Blockchain is the underlying technology that makes cryptocurrency possible. A blockchain network stores information in blocks that cannot be altered without consensus across the decentralized network, making it almost impossible to alter information once it has entered the blockchain. This security creates a level of trust necessary for cryptocurrencies and other virtual assets to exist. So before we get started, let's take a watch of another quick video to get a better understanding of what cryptocurrency actually is.
When you get your next big idea, say sparkly ketchup.
It's Halloween of 2008, and subscribers to a niche mailing list receive a document from a mysterious author. The only clue to who wrote it is an alias penned at the top of the first page, Satoshi Nakamoto. No one knows who Nakamoto is, or even if Nakamoto is one person or a group of people. But the identity of the document's writer is far less important than what's contained within it. Between 9 pages of black and white text is an idea, one that lays the groundwork for something revolutionary. That idea, Bitcoin. You've probably heard of Bitcoin, but might not know much about it. And that's okay. You're not alone. It's complicated. It's like trying to understand black holes or why one sock always seems to go missing in the wash. So let's cut to the basics. What is Bitcoin? Bitcoin is a type of cryptocurrency. Cryptocurrency is digital money that offers a streamlined way to pay on the internet. Paying online is nothing new. We do it all the time. So how is using Bitcoin any different than using traditional money? Let's compare them. For starters, this money can go in your piggy bank. Bitcoin can't. It exists only online and is made of encrypted digital code. This money is tied to a country and controlled by a central power. Bitcoin is not tied to any country, so it's universal. Anyone in the world with internet access can use it, and there's no power or company controlling it. In fact, Bitcoin is designed to be self-sustained by its users in a massive open network of computers worldwide. To use this money online, you need a middleman, like one of these, to transfer your payments. These middlemen often set their own rules, like transfer limits and transaction fees. Bitcoin cuts out the middleman completely, so you can send Bitcoin directly to someone else online anywhere in the world without the need for a bank or any other institution. And since there's no middleman, there are very little rules or fees. For this money, that middleman also monitors online transactions by acting like a referee, overseeing everyone's spending, tallying their money, and making sure no one tries to spend more than they have. It's like going mini golfing with your friends and having someone else who isn't playing keep score to prevent cheating. With Bitcoin, there is no middleman referee. Instead, Bitcoin's users oversee each other's spending using a system called blockchain. Blockchain is a digital public record of every Bitcoin transaction ever made. So you can't spend more Bitcoin than you actually have because your balance is kept in check by everyone else and reported on the blockchain for all to see. It's like going mini golfing with your friends and having each player keep track of everyone else's scores and then comparing them all at the end to make sure they match. So if you tried to claim you got a hole in one when you really didn't, everyone could verify it's not true. And finally, money you spend online is linked to your identity using your personal information. Bitcoin, on the other hand, is not linked directly to your identity, but instead to a secret passcode called a private key that only you know. So if you lose that passcode, you can't access your Bitcoin. Now, you may be thinking, if Bitcoin is nothing more than computer code, how does it have any value? The answer is simple. It has value because everyone who uses it agrees that it has value. Or put another way, as long as people or businesses are willing to accept Bitcoin as payment, it's worth something. There are a set number of Bitcoins, 21 million in total. So think of it like a limited edition collector's item. If more people want Bitcoin, the higher its value grows. In its early days, one Bitcoin was worth around 8 cents. In April of 2021, that value grew to more than $63,000. That's a pretty penny, or should I say, pretty bit of digital code. Anyway, what started as just an idea on paper by the mysterious Satoshi Nakamoto, Bitcoin sparked a cryptocurrency craze. In fact, there are now thousands of cryptocurrencies out there, all with the purpose of being an alternative payment method to standard money. And it's safe to say, the era of cryptocurrency is just getting started. So if you're curious about investing in cryptocurrency and using it yourself, here are some things to consider. The value of cryptocurrency is pretty volatile. It bounces up and down just like the stock market. And if, let's say, enough people decide to drop Bitcoin altogether, it could become worthless. In addition, not many businesses currently accept Bitcoin as payment, but that is changing. Some major companies are getting on board. Microsoft and AT&T accept Bitcoin. Even some fast food chains are now starting to look into it. So there you have it. Hopefully you've learned a thing or two about Bitcoin. Maybe next time we can dive into understanding black holes or missing socks, or if missing socks end up in black holes.
So the value of blockchain started with cryptocurrencies, but has since grown to include many other programs and assets. A trendy example of how blockchain can be used are called NFTs. NFTs are non-fungible tokens. They're digital assets with unique identification codes, like serial numbers, that make them distinct from one another. Blockchains makes transactions like this possible because of the immutable record it creates. When it comes to virtual assets like NFTs, keep in mind that the fact that it is an NFT should not be enough to give an item value. The virtual marketplace is like any other. In order for something to have value, people have to actually want it. A great example of this is the first tweet of Twitter co-founder Jack Dorsey. In 2021, Sina Estavi purchased the NFT of Dorsey's first post on Twitter for $2.9 million. In early 2022, he tried to sell the NFT and was offered just over $6,000. While the tweet is undeniably a piece of history, there are many factors that go into determining value, both in the physical and virtual worlds. The first type of crypto we are going to look at is Bitcoin. Bitcoin was the original cryptocurrency created in 2009 as a solution to typical banking models used throughout the world. Bitcoin is by far the largest player in the current crypto market, holding around 50% of the value of the entire market by itself. Used primarily as a form of currency, but Bitcoin can allow people across the globe to transact without having to deal with complicated exchanges or fees. Simply purchase currency through a crypto exchange, add it to your digital wallet, and send it to anyone, no matter where they are. This chart shows the value of a single Bitcoin in USD from throughout the 2022 year. The entire crypto market has gone through significant challenges this year, and the flagship currency, Bitcoin, is no exception. Since January 2022, Terra USD all but collapsed, removing nearly $500 billion in value from the general crypto market in 2 weeks. The Celsius network filed for bankruptcy. The hedge fund Three Arrows Capital filed for bankruptcy and defaulted on loans from the crypto lender Voyage Digital, who then also had to file for bankruptcy. BlockFi, a crypto bank, filed for bankruptcy. Finally, the flagship crisis for crypto in 2022 was the collapse of the crypto exchange FXT, one of the largest exchanges, worth over $32 billion at the time. As you can see, despite hitting an all-time high in November 2021 of nearly $67,000 a coin, an annual high of almost $48,000 in March 2022, Bitcoin is currently trading for only about $16,800 USD as of January 2023. This represents a 64% drop in value since March. By comparison, the S&P 500 has only dropped 16% during that time. These fluctuations can make holding a Bitcoin investment a stressful experience that's not for people who are unprepared for significant risk or loss. It's important to remember, however, that there is a difference between a loss and a loss on paper. If you do own an investment like crypto that goes through a lot of changes, even within a single day, you need to be prepared to attempt to wait out these fluctuations until your investment becomes profitable. One of the main risks with the crypto industry is that its intrinsic value is difficult to determine, meaning it can be hard to determine if you are overpaying or not. Ethereum is the second largest cryptocurrency available in the market. The currency on the Ethereum network, is called Ether. While Bitcoin is focused on serving as a virtual currency first and foremost, Ethereum targets itself as a blockchain company with many other projects above and beyond the issuance of Ether. Ethereum is the main platform for NFT sales globally, and they run many other apps on their blockchain platform, including apps developed by other companies. As you can see from the chart, a single unit of Ether costs much less than a unit of Bitcoin, making the dollar value of price fluctuations less significant. As well as with all major crypto, Ether suffered significantly in 2022. Similar to Bitcoin, it has dropped 65% in value since its yearly high in January, starting the year at $3,550 and ending it at around $1,248 per coin. So alternative coins or altcoins refer to any cryptocurrency that is not Bitcoin. While this also includes Ether, Ethereum has managed to establish a significant enough hold on the market to be independent. As of February 2022, there are more than 17,000 altcoins in existence, and more are constantly being created through ICOs or initial coin offerings. Some examples of altcoins include XRP, Terra, Solana, and Dogecoin. The primary investment focus of altcoins is speculation. While some coin users do intend to be around long term, there are many coins that are issued for the sole purpose of becoming popular and then selling them. No matter what the underlying intent, until an altcoin is able to secure and maintain a significant portion of the market, they will remain as a solely speculative investment. The lifetime graph of Dogecoin is a great example of the speculative nature of many altcoins. Dogecoin was initially issued in February 2019 for about 0.0019 each, and maintain a similar value for 2 years before growing 1,400% in roughly a month and continued on a downward trend since. The spikes in value are caused by sudden, often unexpected popularity, making it a stressful process to determine when is the right time to sell. In many cases, the trends of altcoins were less affected by the instability in the crypto market over 2022. The altcoins tend to follow a general downward trend from their price eruption, so the dip in the market has merely exacerbated that. There are three main ways to get your hands on some crypto. So there's crypto exchanges. So this is the most efficient way to buy crypto. They have the lowest fees in the industry. However, that comes at a cost of speed, as you need to create an account to get verified and then do a bank transfer. Be wary of fees. Many traders and exchange sites tend to charge a fee to purchase their cryptocurrencies. So some options include Coinbase, Kraken, and Bitfinex, as well as Wealthsimple. As you can see, there are a number of different exchanges no longer available. Please make sure that you check the Ontario Securities Commission regulation before purchasing on an exchange. If an exchange is barred from operating in Ontario, like Binance, it can cause a lot of problems for you getting your money in or out. So fintech companies, so certain existing companies now offer users the ability to buy and sell cryptocurrencies on their platforms through their fees that are higher than crypto exchanges. What you buy cannot be transferred elsewhere to an external wallet. Some of those options include PayPal and Revolut. So with a card, so some platforms offer the ability to buy crypto with a card. These are often sought after because of the speed, but they come at a hefty cost, so about a 3% fee. Some of these options include Coin Corner, Crypto.com, Bitpanda, and CoinMama. ETFs are also available that follow the crypto market, as well as liquid alternative funds like CI Galaxy Ethereum. So what are the risks? Above and beyond all of the risks we've already talked about for alternative investments in general, there are some additional risks that come with cryptocurrencies. So blockchain and cryptocurrencies are relatively new technology, as we saw in the video, which hasn't been proven at scale. When purchasing crypto, you need to store it in a digital wallet. Do thorough research into which wallet is right for you, as this is often considered one of the weakest points for security of cryptocurrencies. While choosing a wallet may seem like a simple decision, you need to understand the risks. Holding the coin yourself can lead to the risk of losing your private key and thus accessing your money, while holding it at exchange can come with entirely different risks, including the possibility to lose some or all of your money if the exchange goes bankrupt. While the prospect of large gains is appealing, according to a study conducted by the Bank of Canada, 18% of current or past Bitcoin owners in Canada said they experienced a price crash. 14% said they lost access to their digital wallet, and 12% said they participated in an initial coin offering that ended up being a scam. It's an exciting prospect, but don't let yourself get caught up in the energy or blindly trust what someone else is telling you. Do your own research and know where you are putting your money, or it may not be your money for long. Another risk to cryptocurrencies is volatility. Some people may try to tell you that the crypto market has stabilized and there's been no significant risk of a decrease in value. This is simply not true. In the 6-month period from November 30th, 2021 to May 31st, 2022, the value of Bitcoin decreased by 45.7%, and Ether decreased by 58.53%, and Dogecoin decreased by 61.7%. During the same 6-month period, the S&P 500 index was only down 9.58%. As we know from our earlier slides, those decreases have continued since May into 2023. So here are our key takeaways from this section. Blockchain technology is what makes cryptocurrencies possible through its decentralized storage network. There are many types of crypto available, from Bitcoin and Ether to the 17,000 other altcoin options. And investing in crypto comes with risk, from the currency itself to the opportunity for scams and the safety of your virtual wallet. So let's review what we've learned today. There are potential pros to including alternative investments in your portfolio, like working as a hedge against inflation and providing different risk and return and behavior profiles. The unique way that alternative investments can act and the decreased regulations can also make them very risky. And diversifying your portfolio can help reduce the risk associated with some alternative investments. In our alternative asset classes section, we covered alternative investments have different risk levels, giving them different places within a balanced portfolio, that there are many ways to participate in alternatives, whether it's buying shares or assets directly or through funds like ETFs, and that you should research before you invest in alternative investments so you understand all of the potential risks. And finally, when we talked about cryptocurrencies, we talked about blockchain technology that makes cryptocurrencies possible through its decentralized storage network, that there are many different types of crypto available, from Bitcoin and Ether to the 17,000 plus altcoins, and investing in crypto comes with risk, from the currency itself to the opportunity for scams and the safety of your virtual wallet. So let's look back at our learning objectives from the workshop. So we wanted to help you know how alternative investment classes differ from the regular market, help you understand the risk return profile offered by some different alternative investments, and recognize differences among how different types of cryptocurrency act and why you might invest in one or the other. So what are your next steps? So do your own research, consider the different alternative classes that we talked about today and what is of most interest to you. Then do your own research to see whether it's something you would actually be comfortable investing in. Paper trade some of these alternatives. So possibly you could do this through setting up a practice account at a discount broker. By using a practice account, you can become aware of the fluctuation patterns of investments. So understand the risk of alternative. So make sure you read all documents and map out what could go wrong before you invest in an alternative investment. And finally, check out more program resources. So be on the lookout for additional program resources, which can help you develop better judgment and help increase your investment returns. Also, there are a lot of different additional resources in the references handout as well. So this brings our formal presentation to an end. Thank you very much for listening patiently. We'll now start our question and answer portion of the presentation. Please be sure to also complete the post-workshop survey. It is important that we ensure these workshops are providing you with the information you need. And if you completed the pre-survey, you will be entered into the draw for one of 4 $50 Tim Horton gift cards.
Awesome. Thanks, Emily. So yeah, I've put the post survey in the chat there. And if anybody has any questions, feel free to throw them in the chat, throw them in the Q&A, or raise your hand, and we're happy to help. Raise your hand, unmute yourself.
I will be sending out Amazon gift cards tomorrow too, if anyone is wondering about that.
Great. Helen?
Yeah, I don't think I got the pre-survey. I don't know if anybody else also didn't seem to get it. Yeah.
The link is in the chat, but I think Chad just put it in there for you again.
Oh, okay. Thank you.
Yeah, I just put it back in.
Anybody else have any questions? Comments? All right, well, if there aren't any questions, then feel free to head out. Thank you so much for attending the presentation tonight.
Thanks, Emily.
Thanks.
Yes,
Michelle.
thanks, Emily, for the presentation. Thanks, everybody, for joining us. Hope you have a great rest of your evening, great weekend. In my neck of the woods, it's apparently supposed to be pretty snowy this weekend. So hopefully it's not too bad. I feel like that's every weekend right now.
I know we didn't have much of a winter until the end of February.
Yeah, and then it decided it was just building up. Now it's going to happen all at once. Okay, awesome. Thanks, everybody. Have a great day.